Hello and welcome back. In our first video, we introduced IFRS 18, Presentation and Disclosure in Financial Statements, and explained who it applies to. Today, we're focusing on the area where IFRS 18 will have the most visible impact, the profit and loss statement. The income statement is the primary way companies communicate their financial performance. And under IFRS 18, that statement is about to undergo one of the most important changes in many years. Under the current IAS 1 framework, companies have significant flexibility in how they present their results. That flexibility has allowed diversity, but it has also created challenges. Similar businesses report operating performance differently. Subtotals are calculated in inconsistent ways, and it can be difficult for investors to compare one company to another. IFRS 18 has been introduced to address exactly those issues by providing a clearer and more standardized approach to performance presentation. From 2027 onwards, IFRS 18 requires that every income statement is organized into three clearly defined categories: operating, investing, and financing. Every item of income and expense must be presented within one of these sections. The objective is straightforward: to ensure that stakeholders can clearly see what relates to day-to-day operations, what relates to investment activities, and what relates to financing. This removes much of the previous formatting flexibility and establishes a consistent structure across industries and regions. For the first time, IFRS 18 introduces defined and mandatory subtotals that all IFRS reporters must include. The two most important are operating profit, which becomes the standardized measure of core business performance, and profit before financing and income tax, which highlights performance before the impact of funding structure and tax, making comparisons easier between companies with different capital models. Because IFRS 18 defines these measures explicitly, they will now mean the same thing in every set of financial statements. Although IFRS 18 doesn't change the underlying accounting numbers, it will change the placement of several familiar items. For example, interest income on cash will typically move to the investing category. Borrowing costs will sit in financing. Forex gains and losses must be classified based on their source, and results from associates and joint ventures will be shown in investing. So while the total profit remains the same, operating profit and margins may look different purely due to these reclassifications. IFRS 18 also strengthens governance over adjusted performance measures. Companies can still present measures like EBITDA, but they must now be treated as management performance measures, disclosed in a dedicated note and reconciled transparently to IFRS subtotals. This ensures much greater discipline and transparency in how alternative performance measures are communicated. To bring it all together, IFRS 18 sets a new global standard for the profit and loss statement. It introduces clearer categories, consistent subtotals, and more transparent disclosures. For investors and stakeholders, that means better insight and comparability. And for companies, it means performance reporting that is simpler, clearer, and more aligned with how businesses are really understood. Thank you for watching, and please join us for our next video, where we'll explain why IFRS 18 comparative requirements mean that the time to start preparing is now.